So an FHA loan is actually a loan provided by your lender. Now, if there's a fire or a flood or something like that, that's where your homeowner's insurance is going to come in. Why do so many people go with an FHA loan? That's going to give you $7,000. Now, mind you, this is just the down payment. Make sure that the property is safe and sound for you, or you're going to have to pay out of pocket. Let's talk about the new loan requirements for FHA in 2024. The first thing you have to understand is, what is an FHA loan? So an FHA loan is actually a loan provided by your lender, but is backed by the Federal Housing Administration, and essentially it's insured just in case you default on your loan. The reason why they have it set up like this is because you're putting down less than 20%. FHA loans require only a 3.5% down payment. So anytime that you're putting down less than 20% on a property, they're going to have you get what they call mortgage insurance. Now, we're not talking about homeowners insurance. We're talking about mortgage insurance. So homeowners insurance is something that actually protects the dwelling, the actual property itself. Now, if there's a fire or a flood or something like that, that's where your homeowner's insurance is going to come in. But your mortgage insurance is going to be called what they call a PMI, okay? And that private mortgage insurance essentially, again, ties into protecting the lender just in case you default on that property. And usually, now the rate is going to move around, but it's going to be anywhere between about 1.5%, 1.75%, somewhere in that range of the amount that you borrow. Now, you can ask your lender how much that's going to end up being, but on average, a $250,000, $300,000, $350,000 house, that means it's about $200 to $300 a month. And again, your lender can let you know exactly what that is, okay, and how much that's going to be. Why do so many people go with an FHA loan compared to a conventional loan? Well, I mentioned the number one reason, and that's because some people they simply don't have 20% to put down on a property. If you don't have 20% to put down on a property, don't get me wrong, you can get down payment assistance, you can get seller credits, you can get all different types. You can get a gift from a family member or a friend, so you can most definitely come up with this money, not necessarily 20%, but money in general can come from different sources. So some people, it's easier for them to come up with 3.5% of the purchase price versus 20% of the purchase price, okay? So for example, if you're looking at a house that costs, let's say $200,000, okay? So I'm going to take out my calculator and we do 200,000 times 3.5%. That's going to give you $7,000. Now, mind you, this is just the down payment. We haven't gotten into closing costs. That's another video, okay? But either way, that's 3.5% of 200,000. Now, obviously, if we do $200,000 property times 20%, that's going to be $40,000. So the question is, would you rather put down $40,000 or would you rather put down $7,500? Okay. And so again, if you want to do that, you're going to most definitely be looking to save a tremendous amount of money if you put down the $7,000. Okay. So here's my calculator. We're going to go ahead and calculate 200,000 times 3.5%. That's $7,000 that you're going to need to go ahead and start the process of buying that home. Now, again, that's just your down payment. This does not, I repeat, it does not include all of your closing costs. Okay. This is just to show you an example of what 3.5% is. So 3.5%, that's 7,000. Then you have 200,000, again, same purchase price times 20%. Okay. That's 40,000. So the question is, buyer, would you rather put down $40,000 as a down payment, or would you rather put down $7,000 as a down payment, right? And so again, that's one of the number one reasons why people go with an FHA loan, is simply because they only ask for 3.5% down. The second thing is that they have to do an inspection. Now, when they do an inspection, this is not your personal inspection that you normally do once you go under contract. Okay, that's when you're going to inspect the property, make sure that the property is safe and sound for you. The bank is going to do their own inspection, more like a safety inspection, really. It's just to make sure that there's no peeling paint, that there's no cracks in the foundation, or again, these are going to be what you call an FHA appraisal, and they're going to essentially look at the value of the property as well as the safety conditions as well. And so with the FHA loan, they will finance up to 96.5%. That's why you have to make up the difference, which is 3.5%. But since they're doing that, they have to protect their investment. They have to make sure that the house is worth the amount that you're paying for it. Because let's talk about that. Let's say, for example, you go under contract on a house that's $300,000, but then they do the appraisal, and then the appraiser says, hey, this house is worth $295,000. That means the seller either has to reduce the price that you guys agreed to, or you're going to have to pay out of pocket for that. Okay. And most cases, the seller would just reduce the price, but we have seen some situations where they wouldn't, and the person had to go conventional to get that property, okay? But again, that's why people end up going FHA, because they figure, hey, not only did I do an inspection, but since the bank has done their inspection as well too, and again, small safety inspection, there may be some things that you saw on your inspection report during your personal inspection. You may have asked the sellers to address those issues. The seller says, hey, I'm not going to address these issues. Then your lender does a very similar inspection and they say, hey, if you want this buyer to get this loan and close on this property the next couple weeks, we need these items taken care of. And now the seller is now painted into a corner. Not that they is a guarantee that they're going to fix it, but now they know that you can't get that loan unless they go ahead and make those repairs. Okay. And so again, that's another reason why people go with an FHA loan. Number 3 is going to be credit score. Now, when you're looking to get a home loan, again, the most popular loans are going to be conventional, FHA, and VA. We'll talk about those other two in another video. But for time purposes, with the FHA and conventional loan, usually you're going to have obviously a certain type of credit score. With an FHA loan, you can actually have a credit score as low as 580, okay? 580 without the drama. Now, if you want drama, then you can go ahead and then apply for an FHA loan if you have a credit score anywhere between 500 to 580. If you go that route, you're going to have to put down 10%, okay? So if you want to be in a situation where you have to put down 3.5%, you won't get the best terms available though, okay? So you have to understand that. So the best terms available is usually going to be what they call the market rate. The market rate is essentially what the rates are on that particular time, okay, when they lock them in. But you may be a more riskier profile, which is why they're going to have you more than likely at some higher fees or a higher rate if your score is under 620. So if your score is under 620, then you want to make sure that you understand that it's going to cost you more to get this home loan. You really want to push to get 620, okay? So what I've seen people do is they'll get the pre-approval at 580 and then they'll start looking for homes, but then in between that time, they're still working on their scores. That way they can qualify for the best terms available, or they may want down payment assistance, which usually some states or most down payment assistance programs are going to have you needing a 640, okay? So you really want to be a 620 or higher, but if you're pressed for time, you don't care about what the numbers are, it's going to be a 580. But again, I tell people all the time, just because even if you're a 620, 720, 850, right? If the rates are higher than what they were years ago, because right now that's the case, right? Then it doesn't really matter, and because you're going to end up refinancing anyway. But if you buy a property and you're under 620, same thing. I'm not saying it doesn't matter. I'm saying that you're going to want to put yourself in position to refinance anyway, because even if you had A1 top of the tier line credit, you're still not going to get a phenomenal rate. It's just a matter of anyone that has a 620 or higher, 720, 850, they're going to get the best terms available, which is the market rate. But again, you're going to more than likely end up needing to refinance anyway. Number 4. Now let's talk real quickly how you can actually see your mortgage scores. There's 2 ways to see your mortgage scores, okay? Because these are the scores that they actually go by when you're looking to go into homeownership. So to see that mortgage score, there's 2 ways to do it. Way number 1 is to start with a lender. They're going to have you fill out the application, which is going to be a hard inquiry, also known as a hard pull, and then they'll see what that's going to look like. They'll see your credit score, okay, and your report. But since that's a hard pull, you may lose a couple of points, but it's not the end of the world, okay? Now, another way around that, it's not really around it, but you want to actually see the scores prior to. To do that, you go to myfico.com. That's myfico.com. You can actually see their advanced plan for like $30 a month. You don't need to keep it. It's up to you, optional if you want to or not, but this is the only way to see it this way. You see those mortgage scores, and then you drop the highest, you drop the lowest, and then whatever score is in the middle is going to be your middle mortgage score. That's the number that they go by to determine your eligibility for an FHA loan, or any loan for that matter, honestly, okay? And we always recommend seeing that score prior to. That way you already know that your score is there. A lot of times people say, oh, I saw my credit score from my credit card. That is an overall score. I saw my credit score from Credit Karma. That is a different algorithm. I saw my credit score when I went to the dealership. That's a different algorithm as well. That's a different category, okay? We're talking about mortgages. Again, people don't know that this is how you see it, but at least you know how to see those scores, so you know that you're not wasting your time or your lender's time. Number 4, you must occupy the property within 60 days of closing. Okay, let me give you a couple of examples of what that means. So getting an FHA loan means that it is your primary residence. Okay, but there are some times where you try to get the property and there's someone living in the property. Let's say that there's a tenant on it living on the inside of the property, or it's a 2-unit property and there's a tenant living in there as well. And you say, okay, well, their lease is not up yet until a certain time. As long as the bank sees that out within a 60-day time frame, then they will consider that as your primary residence. Okay, because they're assuming if you're applying for this loan, they're going to ask you, do you plan on living in this property? And they're going to say, hey, do these people plan on being out, or does one livable unit, is they're going to be available within 60 days? If the answer is yes, then they're going to go ahead and allow you to have this type of loan. Now, again, you can go FHA up to 4 units. Okay, that's number 5, is that you can go up to 4 units. Anything past 4 units is considered commercial. Okay, so but again, back to the 2-unit example, as long as they're moving out within 60 days, or even if you're buying a single family and someone's living there, as long as they're moving out within 60 days, you are able, you're going to be good to go. And then last but not least is going to be FHA income limits. Now, there's really no income limit as to how much you are making or necessarily how little that you're making. It's going to really come down to what's the lowest amount that a lender is willing to finance. Most lenders, in even like very cheaper areas, they're going to go as low as about maybe 60 to 70,000, 50,000 if you're lucky, but about 70,000 is really the lowest that many of these banks will go. And so in order to qualify for that, you really need to be around about $14, $15 an hour. And even with that income being at that number, that's even tight within itself. So again, if I would say any number that you want to shoot for on a per hour basis is about $15 an hour. And again, but that doesn't determine or factor in your other debts. Do you have a car note? Do you have personal loan payments? How long have you been on the job? So there's a lot of other factors as well too. But just to answer the question, $15 an hour is usually going to be the minimum amount that you're going to need. Obviously, if that doesn't work in your area, then that means you're going to end up needing a co-signer, or you may have to consider going into an attached property like a condo or a townhome, for example. And that's everything you need to know about the 2024 loan requirements for FHA. If you like this video, like it, and we'll be sure to meet you at the next video. See you there.